Good afternoon, everyone. This is Tim McCusker, Chief Investment Officer at NEPC. Thank you for joining us for our third quarter quarterly market update. As you know, we've done these calls for many years in January and decided this year that it'd be helpful for you to hear from some of our senior research professionals on a more regular basis with markets as dynamic as they are. We want to share our current views as regularly as we can. And so we've been doing this for a couple quarters now, and excited today to bring you updated information on what we're seeing, particularly relevant given market volatility, but also internally at NEPC, we're going through our annual assumption setting and capital market outlook process. So that's all happening in real time right now. We had a prerequisite today that you had to be named Tim to join the call. So I'm joined by Tim O'Connell, senior leader on our traditional research team, and Tim is going to talk about a focus on equities today. As you're listening, if you have a question, feel free to go to the right-hand side and type in any questions that you have in the question pane. If we have time, we'll hopefully get to those. If we run out of time, we'll certainly download that question and have your consultant follow up with you. So I'll go through a global outlook and what we're seeing going on, tying that back to the key themes that we see in markets. And as I mentioned, Tim will spend some time focusing on equities with a particular interest on value versus growth. We wrote a blog recently, Tim wrote a blog recently talking about this. So we'll summarize that and talk about what's happened most recently with some of that performance inverting. I'd encourage you to go to our website and look at all of the materials that we're putting out there. Lots of blogs and current market outlooks, updating those day to day. So let's get to the global outlook. You can see for the third quarter, more up and down across the board, but really a U.S. story, and we'll talk about that as we get into the key themes. The S&P 500 up 7.7% for the quarter. International equities eking out positive performance despite a pretty strong dollar. EM lagging a little bit. And that was particularly true in the August timeframe as EM really started to sell off. We've seen rates rise, volatility fall, and credit spreads continue to do pretty well despite rising interest rates. At least flat performance for the broad U.S. ag and positive performance for high yields. If we zoom out and look at performance overall for the year, you can see what an outlier U.S. equity and U.S. risky assets in general are relative to the rest of the world, at least through the third quarter. Now, at this point, the S&P 500 and Russell 2000 have given back a lot of their gains, but we've seen that negative performance over the last week and a half as pretty broad-based, so they're still maintaining a pretty solid lead over most global markets, and the U.S. dollar continues to be really strong. And so let me turn now to our key themes. We talked about these in January and talk about them with you throughout the year. And really, they're meant to be the underlying support for what's happening in markets, the key drivers that shift performance and shift pricing. To the extent that they play out as expected, we would expect relatively strong performance from markets, but to the extent that they are disrupted in some way, we would expect outsized performance in one direction or another. 2017 was a great example of that. Many of these themes were in place in 2017, and we saw several of them have upside surprises and really strong performance broad-based across most capital markets. This year, we've seen more volatility in these themes in both directions. We've talked for several years about an extended U.S. economic cycle, that economic cycles don't just die of old age. We're continuing to see that play out with a surge in U.S. economic performance due to fiscal stimulus. We thought at the beginning of the year that the rest of the world was catching up. We were seeing that in the second half of 2017. We've seen that pivot a little bit. We've seen the Fed and other central banks be very supportive of economic performance, but that has shifted this year as the Fed has tightened and begun to tighten more than a bit ahead of schedule. And of these themes, that is one that we would say has gone away. The China transitioning process continues to take place, even with some volatility as they deal with some growth issues and deal with trade tensions, which is a new manifestation of the globalization backlash. As we've talked about that for the last couple of years, that started out as something playing out in elections and in politics, that populist candidates were getting elected, populist candidates were getting onto ballots. We saw that die down quite a bit in 2018 as despite a number of populist, in 2017 rather, as a number of populist candidates in Europe were defeated. We're seeing it play out in a different way in 2018 as the U.S. in particular puts together tariffs, raises trade tension across the board. I would say all of these themes are under review at this point as there's been disruption to each of them, but I thought just diving in a little bit and looking at the major undercurrents that are happening in 2018 and tying those back to the key themes would be helpful. So major undercurrents that we see are U.S. fiscal stimulus, the tax package that was signed into law just before Christmas of last year and effective in 2018. U.S. Fed tightening as short rates begin to rise. And as a result of that strong dollar across the world, some acute challenges in EM, of course, China struggling a little bit more and starting to ease a little bit, but some smaller tensions in places like Turkey and Argentina, not small to them, but Turkey and Argentina are fairly small in the global economy, and then the trade tensions that I talked about. Now, what do each of these mean relative to those themes? First, U.S. fiscal stimulus, very positive for the extension of the U.S. cycle. That's been a nice burst to global growth, or to U.S. growth rather, and has allowed GDP growth in the U.S. to pick up. It's been bad, technically, for synchronized global resurgence because it's pushed the U.S. ahead of the rest of the world. We've seen stronger growth and an uptick in growth in the U.S. as it's moderated just about everywhere else. It was negative for Fed gradualism because the Fed had the flexibility to tighten more than expected with the strong economy taking place, and probably more neutral for the transition in China and globalization backlash. Fed tightening, again, tough for the synchronized resurgence because it meant that rates were higher in the U.S., and it was in the face of a strong economy, so the U.S. doing really well, and clearly directly tied to breaking up that Fed gradualism. Strong dollar, again, that strong dollar hurting some of those EM countries and those with U.S. dollar-based debt, and then a direct result of that Fed gradualism. The EM challenges causing a little bit of a downdrift in EM growth, hurting that synchronized resurgence, and then also directly hurting China, the China transition theme. And then the trade tensions, hurting certain economies, or at least hurting the perception of trade and GDP growth in certain countries, hurting that synchronized resurgence, and then directly attacking China, challenging their ability to transition, and then falling under that globalization backlash theme. So if I were to flip back through these quickly, just to show you optically, you certainly see a lot more red than green. So you're seeing these themes come under challenges right now. And that's expected. That doesn't mean that those views were wrong. These themes were laid out with pluses and minuses, and we had the expectation that some would play out positively and negatively, and we're seeing more play out negatively right now. I'll dive in a little bit on a few of these. First, the strength of the U.S. economy. We've talked for several years and have shown a chart to you several times of U.S. economic growth in this cycle and previous cycles. We had talked about it being the third longest recovery, but still one of the weaker recoveries. Even with this jump up in growth so far this year, it's still, the magnitude of the recovery is not particularly strong, but with one more quarter of positive growth in the fourth quarter, which barring something unforeseen, we would expect, this will now become the longest economic cycle since World War II. So we are looking at an extended cycle here. And one of the things that we're talking about as we shift that theme is the dynamic of going from what I would say, as we've talked about that extended cycle, the real message under there was an extended mid-cycle, that things are going really well across the U.S. economy and we'd expect that to last for a while. What we're seeing now is more of a shift to the late cycle. And you see that a little bit if we start to drill down into sector performance. Here we have from the MSCI USA index, cyclical sector performance minus defensive sector performance. And you can see that, and when this is positive, cyclicals are doing really well, and when it's turning down, defensive sectors are doing really well. And you can see that turn that we've seen recently in particular, and really in the second half of 2018, that defensive sectors, those less exposed to the cyclicality of the economy, are performing better than more cyclical stocks now. And that's a reflection of the earnings of those companies starting to come through, although earnings continue to be pretty strong across the board. It's also a reflection of expectations of the market, expecting those companies to hold up a bit better than cyclical companies. The drop in synchronization we show here, annual GDP growth over the last few years for emerging markets, the US, the Eurozone, and Japan. And what we were seeing in 2017 was a nice uptick in growth across the world. Everything was trending upwards, and it looked like that could continue for a while. EMs were performing better. The US, even without the fiscal stimulus, was looking strong. And what we've seen in 2018 is a bit of a reversal from most of the world, except for the US with that fiscal stimulus. So that fiscal stimulus has allowed the US to continue to expand above expectations, while the rest of the world has seen a little bit more subdued growth, maybe at the expense of the US with that dollar strength. Now, I think it's important that the story here is not all that negative. If you look at where those dots are, they're still positive. They're trending downward relative to where they were, and they appear, the expectations are that they will trend downward a bit further, but still positive. So we see some downside risks now in the economy and across markets, but we do think this extension of the cycle can last for a while longer. And while we're entering the late cycle and dynamics become a bit different across markets, we do think that economic performance and market performance can still be okay for a little while. The theme that has really been disrupted is on rates. And so you can see that here, what that means for the rest of the world. Here's the 10-year US-German spread and how out of whack that has become, another almost 75 basis points upward over the last 9 months or so. And so this is where taking risk in the US versus taking risk in Europe starts to, you can see the differences, that it's just, this doesn't seem sustainable to us. And that's a reflection on the path of the Fed versus other central banks. And so this is the shutting down of a theme in taking that Fed gradualism theme off the board. And so going back to the end of 2015, you can see the expected path of Fed funds. It was the rate was 25 basis points, not expected to get up above 2 until 2018. If we fast forward that to the end of 16, it was really just pushing that out. There was one rate hike the whole year, and those expectations just got shifted out 1 year. The end of 2017 saw short rates rise, but expectations of long-term rates or long-term short rates remained relatively subdued. So that gradualism is really in place for expectations over a 3-year period and then outward 2 years beyond that. And then as we stand today, you can see that big shift. You can see flattening further out, but some steepness over the course of the next year. And I think the real challenge for markets now is that blue line is market expectations. The diamonds that you see are the Fed projections of where they expect to be at the end of 19, at the end of 20, and those are above market expectations. And that's where the tightening really starts to hurt. When those tightenings take place and the market hasn't priced it in, that's a disruption for rate markets. Rates need to reset to account for that, and all markets need to rediscount as a result. This is happening more subtly on the balance sheet side. The Fed has done, and this has been with limited disruption to global markets, but the Fed balance sheet is now down $300 billion from its peak, and they have the potential to draw that down another $50 billion per month. This this perspective is even more stark if you look at it as a percent of GDP, because the U.S. economic growth has been pretty strong on a nominal basis for several years now. So you've got 4 or 5% growth each year in GDP. So even that flattening of the balance, that flat balance sheet gets smaller and now starting to shrink. It's shrinking in a more magnified way relative to the overall economy. And globally, we're starting to see the implications of that. We showed you what that means for the U.S. versus the Eurozone in terms of rates and accommodation. You're seeing that globally, that the cost of taking on debt is higher than it was 6 months ago and than it was a year ago, by the order of almost 100 basis points. And that starts to bite away at risk appetite. That starts to bite away at investment decisions for corporations, and savings and debt decisions for individuals. And this is sort of classic business cycle type dynamics. And so lastly, the trade tensions. We talked about this last quarter, and this seems to be, as much as there can be status quo in something where there's a lot of unknowns still, not much new has happened here, and there's a lot of headlines that come with this. The economic impact is somewhat limited. Maybe, a lot of forecasts that you see are less than 1% of GDP if fully implemented. I think the downside risks are if this gets extended beyond what's already been announced, if other countries get thrown into these tariffs, then we start to get into a global trade war. That's not our base case right now. We would expect sort of a Cold War type setup where what's been in place will stay in place. Maybe there'll be some negotiations, but no one wants to give an inch here, so we would expect more of the same for a while. This has affected markets, and you can see that here. Green is the S&P 500. As these tariffs have been announced, you can see the U.S. soaring ahead, although there's been some correction there more recently. But for broader EM and for China in particular, you can see the big downturn that we've seen this year, at least somewhat due to some of these tariffs that have been put in place. Clearly, there's some growth challenges in China that they're addressing and trying to work through, and you're seeing some monetary and fiscal easing taking place in China now to try to address that. But the trade tensions definitely weigh on their equity markets lately. In terms of opportunities, again, reassessing all of these right now, but with those themes evolving mostly, but not completely disrupted, many of these opportunities remain in place. We do think it's critical to trim some of those equity gains, although there's less of them than there was 2 weeks ago, but hopefully we've been talking to you about that for several quarters, and those gains have been taken off the table and resized back to target. We still believe in developed and emerging market equities. If anything on here is more important than others, as we get into the late cycle, we do see the need for increasing safe haven fixed income exposure to start to get more defensive. And so that's something that we'll be highlighting more and more as we get into year-end planning and messages in the new year. So with that, I will turn it to Tim to talk about equities and the value growth dynamic, and then we'll have some time for questions at the end as well.
Perfect. Thank you, Tim. So before we get into value growth, I just want to hit on a couple of slides. The first is just a basic overview slide. If we look at the third quarter, Tim already covered a lot of the index returns on the top right that we see over the quarter, with emerging markets kind of being one of the worst performers. I think more importantly, if we look at the bottom left, which is the Russell 3000, so kind of the all-cap benchmark for the U.S., you'll see the largest contributor on the quarter is information technology, and you see communication services, which is kind of telecommunications, underperforming. This will play in a little bit as we talk about value growth in a couple of slides, but we'll kind of start with this. And then before we shift, I just want to highlight two slides from a presentation a couple of our asset allocation team members put together on emerging markets, which is basically restating the case for emerging markets and why we think of it as a theme. So I would suggest, as I go through these, that if you find it interesting, please do reach out to your consultant to get a copy of that deck as you think about ways to implement emerging markets. First slide really just breaks down emerging markets into the local equity return and the currency return. Tim talked a little bit about the strong dollar, really negatively impacting a lot of emerging markets. And I think this slide does a nice job, particularly in Brazil, South Africa, South Korea, of just showing the magnitude of the currency depreciation you've seen in some of those countries. And then one of the other slides just talks, and it's a backup slide for part of our emerging markets theme, showing the relative value compared to kind of the developed world on both a price to earnings and price to book level. We continue to see this attractively priced compared to kind of most of the assets, which also informs part of our trim U.S. equities and positive emerging markets messages. So with that, let's talk a little bit about value growth. So in September, we published a blog post, will growth have the last word? The main message here was to look at recent dispersion between value and growth, whether that's in the U.S., international, or emerging markets. And so I'll kind of cut to the punchline here, and then I'll go through some of the background slides. The main recommendation was really twofold. One, we noticed as we had conversations with clients that some of the underperformance could be where you're using kind of an incorrect benchmark. It might be a really deep value U.S. manager compared to even just an S&P or kind of a broad benchmark. And this is more acute in emerging markets where we saw a pretty large dispersion between EM growth and EM value over a number of periods. So kind of the first recommendation is just reevaluate, the asset class benchmarks as well as the individual manager benchmarks that you're using on an ongoing basis. And the second part is just reevaluate the managers that have underperformed both the benchmark and the asset class holistically. We'll talk about this for emerging markets. It may not necessarily be don't fire the managers underperforming. Take a look holistically at maybe a value manager combined with a growth manager and see how the combined portfolio is doing compared to a broader benchmark. But also think about where you're getting some of that exposure elsewhere. In emerging markets, you may have a global manager that has a lot of EM or kind of a non-US, an ACWI, ex-US that has a substantial EM. So think of those combined and not necessarily on a line item by line item basis. So going to actions, we talked a little bit about the emerging markets, so we'll start with the US. Consistent with our themes, this is probably or was a better point a couple of weeks ago. As Tim mentioned, you probably had some of these gains trimmed slightly over the last couple of weeks as value has performed a little bit better than growth kind of in the downturn. Thinking about rebalancing and trimming some of these gains. And the second bullet point here is probably one of the most important. You can choose to redeploy that into kind of some of our non-US or emerging markets, but also think about maybe using it to add to some of your safe haven fixed income. Don't necessarily think of it entirely in an equity bucket, but more in a portfolio. And then the last part is, in part of this rebalance, just think about the weight long-term for value growth, whether that's US, international, or emerging markets. I've kind of made the point about emerging markets already. The additional point here would be, as you've thought about emerging market portfolio construction, think a little bit about if you have sole value or a deep value manager in emerging markets, holistically and long-term, maybe complementing that and coming up with a game plan for the next 6, 12, and 18 months to how to balance yourself towards more of a core or even adding a little bit of growth exposure. And then I'll show you some slides on international. The value growth is a little bit less important. So a lot of background, a lot of conclusion here, too many words. Let's go to some slides. So value and growth do exhibit kind of a cyclical behavior. What we show here is a rolling 5-year return differential. And you'll see in green is kind of when growth has outperformed and value outperforms kind of in the white sections. Since the crisis, we've seen almost exclusively growth outperforming in the US compared to value. And that's really been pronounced kind of the last 18 months, the last 18 5-year periods. Why do we think this is the case? Well, there's a couple of reasons. Let's take a look at where the value growth differential on a price to earnings basis was back at the crisis. And I think this really sets the stage. Yes, growth has outperformed, but the main reason for this since the financial crisis is that growth was actually as cheap as it's ever been to value going back to the early 90s. So it was actually a great opportunity to buy into some of the growth stocks, and that combined with really the market gains you've seen from some of the FANG and other stocks and information technology companies really growing market share, along with strong earnings, has really helped this growth outperformance really over the last 10 years. So on the right in the red box, you'll see we're actually pretty close to the long-term average, so the differential between the two. So while growth was extremely cheap in 2008, 2009, it's a bit more expensive today, but it's not as expensive as it was, during the tech bubble and crash. So let's take a look at this on a more point-in-time return basis. We looked at the U.S., and I talked a little bit about how growth has outperformed value. And it's really that last 1 year number where you've seen, the growth. And again, this is through September 31st. These numbers are going to look pretty different when we rerun this over the next week or so. And you saw a really large differential over this past year. And I think that's where you're seeing a real big difference. If we go and look at the EFI, so international markets, or EM, the dispersion between the two is just not as large. And so these are really point in time. And if we look at that over a 1, 3, 5, and 10, growth has outperformed in the non-U.S. markets, but not to the same magnitude that it has in the U.S. And long-term, since inception of each of these benchmarks, which is the 70s for international in the U.S. and in more recent 2000, and you've seen a little bit more of a balance between the two, with values slightly outperforming over the real long term. So let's look at the same chart from the first page, which is the return differential between value and growth. And let's do that on international markets and emerging markets. So if you look on the top, you'll see in the EFI markets, historically value and a number of the value managers that we've used tend to have pretty consistent returns. And there hasn't been as much of that growth premium, per se, in international markets, really except for kind of post-crisis. And it's not to the same degree that you saw in the U.S. You're seeing about 300 to 400 basis points. And so, being a little bit more balanced or even a little more value internationally has probably not hurt as much. Whereas in emerging markets, and again, this is starting in 2000, so it's a shorter time period, you have seen a bit of a shift similar to the other two regions, but it's been a slower shift. And so this was the point we made earlier. There's part of the reason you're investing in emerging markets is for kind of long-term growth. It doesn't necessarily mean just buy a growth manager or overweight growth. Think of it balanced. Don't necessarily just have a sole value manager in emerging markets. And this is where we are talking to clients a lot now about the holistic portfolio construction longer term. So the last page, and we show this every quarter internally and externally, is just our beta group, our equity beta group's views, which are combined with the themes that we get from our asset allocation team to talk about implementation views across markets. These haven't changed much so far in 2018. As Tim mentioned, we're kind of reevaluating the implementation choices in kind of an international emerging in the U.S. And so you may see some slight tweaks to this in our January time period, but continuing to like kind of small cap implementation, particularly in emerging markets and international markets.
Great, thank you, Tim. We do have time for a few questions here, and I'll take the first one here. It's about a chart that we showed earlier on the U.S. 10-year versus German bunds, and we mentioned that we didn't expect that the spread that exists today and the way that it's increased to endure, and can we elaborate on that? Happy to do that. I think there's a couple reasons why we don't think that that is sustainable. Although if you look to Japan and look at the difference between U.S. and Japanese JGB rates, it certainly endured there. But the reasons why we don't think that's as sustainable is one, I think the ECB has only so much more that they can do. As you saw earlier, even though European growth is not as strong as the U.S., it is positive, and so we are seeing some more solid footing from Europe, and would expect the ECB to take their foot off the pedal a little bit, although Italy is a downside risk that could moderate that. So that's one, that we think the ECB will likely take some action to move those rates upward, and would expect that to start to get priced into markets. The other is inflation, that to the extent that we do see some inflation as part of these late cycle dynamics, you would expect that to be priced in, to start to get priced in across markets. You'd expect that to be more of a global phenomenon. Although it's not strongly priced into U.S. markets, it's much more priced in than in European markets, and we would expect some of that to normalize as well. And I think just in a global economy, the economies are not so different. The currency values are not so different that you'd expect the rates to be to depart as far as they are, or even further from where they are today. We have a question for Tim on active management, given the comments on value and growth. How have active managers in the equity space performed this year, and how do you think they're holding up during this recent downdraft in October?
So if we think about it, and I'll kind of speak a little bit more anecdotally since we don't have all the hard data in front of us. In the U.S., so much of the return has really been driven by kind of, do you have the FANG stocks and how much weight do you have in them? So as we've seen growth kind of retract the last kind of 10 or 15 days, although today's a positive day for many of them, we will probably see some outperformance. So it's lagged until September. You'll probably see more value or quality managers kind of eke back some of that negative performance. You know, I think a lot's going to depend on how much the market moves down from here, or do we see some of these stocks kind of rebound in the U.S. In emerging markets, it's been a bit more of a mixed bag. I think what we've generally seen in large cap emerging markets is, you know, value has underperformed but rebounded through September. And a lot of it really had to do with currency, and of the managers we've covered, currency and country. So depending on if somebody was overweight Brazil, overweight Turkey, maybe even underweight China would have helped them this year. That's where we've seen the largest dispersion. And I think, you know, we'll see a similar story in kind of international markets. You know, don't have the hard data, but that's kind of more of an anecdotal deal.
Great. Okay, a couple more questions here, and then we'll wrap up. First, do you expect the Red Sox to win the World Series? That's actually not a question. I just wanted to talk about the Red Sox for a second. Go Red Sox. And then the last question, the question about one of the opportunities. You talked about safe haven, fixed income, and raising targets there. Can you talk about how that sets up relative to a rising rate environment? That's a really important question. And I think having that safe haven fixed income exposure helps in a recessionary environment. And if we do get a recessionary environment, we would expect rates to fall and expect that piece of the portfolio to do well. If we get inflation, and inflation is driving growth downward, that is a challenging period for interest rate exposure for safe haven fixed income, and likely for equities, and that's why we think part of that safe haven fixed income exposure should be an allocation to TIPS as well. So we are thinking about the different ways that this economic growth could unwind, and think it could be through a downturn in growth or an uptick in inflation, although we're not expecting a major change in inflation in the near term. So that's all that we have for questions, and we've kept it to just over 30 minutes. So I want to be efficient with your time. I want to thank everyone for joining us today. Look for a lot more from us in the coming months on what's going on in markets, and then of course in January we'll have a webinar to talk about our updated views and be out to all of you with our updated assumptions and key themes. Please reach out to your NEPC contact if you have any questions, or reach out to any of us in research if there's anything that you'd like to follow up on. So thanks, and once again, go Red Sox.